Yes, it is.
Okay, so welcome, Mr. Mehta, to Fin Medium series of the investor interview. We are interacting with the industry stalwarts, and definitely you're one of them, to guide us through various instruments, to guide us through various tips so that we can really gain a lot from your own experience and the experience of the fund house that you're a part of. So to give a brief, Mr. Mehta is a fund manager at one of the most reputed and respected fund houses in the country, that is PPFAS. And welcome, Mr. Mehta. And I'd also now request you to share your background with us.
Yeah. Thank you so much for having me here. Hope everyone is safe at home in this terrible times that the country is going through. Hope everyone is safe at home. Just to give you a background, so I started off as an intern with PPFAS Mutual Fund back in 2011, 2012. And since then, I have moved up the ranks and a fund manager since 2016 with them. So I handle both equities and debt a year, and it's been almost 9 years now with PPFS. So that's the brief background. My first job, and right now also working there.
Wow, so that tells a lot about you as well as the fund house you're a part of.
Yeah.
So, anything that really shaped your personal investment philosophy? What is your personal investment philosophy? And, if you have any mentors or something that has guided you in this journey.
So definitely, everybody has mentors. So I have three or four of them. So one is obviously Warren Buffett, the father of value investing. So I had the chance to attend the Berkshire Hathaway meeting in US back in 2017, and those annual meetings that Warren Buffett holds is in itself, knowledge that you can gain over the years. So that has been very helpful to me. The other mentor which I look up to is Philip Fisher. So not many people mention about Philip Fisher, but something which the philosophy which he had about the growth investing and growth stocks is something which stayed with me over the years, and that has also helped me. Obviously, Parag Parikh, late Parag Parikh, who is our founder, is also was also a mentor, and he guided me initially. After that, Rajiv Thakkar, who is our CIO, so he's been mentoring me, and I have learned a lot of things from Rajiv Thakkar. So some things which are very important in investing. So some softer aspects like discipline, temperament, and patience are some things which I have learned from Rajiv over the years. So yeah, all these have been my mentors. Yeah.
Great, great. Thank you so much for sharing. I think a lot of investors, a lot of seasoned investors look up to all these people you've mentioned, including
Yeah.
Mr. Parag Parikh and Mr. Warren Buffett. So, moving on, I'll not take much more of your time, and moving on to the investment perspective. So, I would really like to understand, like what would be your approach, or what is an approach that you suggest towards building an ideal portfolio with respect to debt, equity, various asset categories?
So every investor needs to have his or her own financial plan, depending on the risk appetite, depending on the needs, and depending on the stage of life that he or she is in. So depending on that, you need to come up with a financial plan, and based on that, you need to have an asset allocation in place. So it can be a mix of equity, debt, real estate, gold, etc. Again, equity can be in the form of either mutual funds or direct equities, depending on whether you have knowledge and the time to track equities, then you can invest directly. If you don't, then it's better to outsource it to a mutual fund, where you can start with even a 1,000 rupee investment. Whereas for ultra HNIs and HNIs, other options are PMS and AIF. So these are the brief options that are there in equities. In debt, so it's a complicated category. There are in mutual funds also there are about 16 categories. So it's a complicated segment as such. I don't know whether it's that complicated that it is made to be, but yes, the basic principle is that you should lend to someone where there is a guarantee of getting your money back. So that should be the basic principle of debt. So uh, obviously, bank fixed deposits and government small savings schemes are also a part of each investor's portfolio. But within the debt mutual fund space, it's better to keep your portfolio as simple as possible rather than complicated by having investments in each of the categories.
I'll extend this question since you mentioned about debt and the complication the debt has. So I would want to, so an Indian investor, basically a simple Indian investor, would have this option of fixed deposits, a fixed return, no tension. But if we move on towards debt, then there is overnight fund, liquid funds, money markets, and so many other options. So why would a person actually shift to such a complicated category when the result is pretty much the same? So
So,
yes.
yeah, bank deposits traditionally have been a safer product compared to other mutual funds because banks have been able to repay on demand whenever the investors have asked for it. In the recent years, we have seen some banks also blow up and not able to pay up the investors. So that has come up in the last few years. But on the debt mutual funds side, we have seen even greater troubles in terms of IL&FS and other subsequent defaults that we have seen in the last 2 or 3 years. So again, these debt mutual funds, what they do is they give tax efficiency in terms of returns. So if you invest in a bank fixed deposits and if you are in the 30% tax bracket, then what you are earning is effectively less than the inflation. Then it's not even taking care of the inflation. So that's a drawback that the bank fixed deposits have. At the same time, it has the option of liquidity in terms of you can break the FD anytime you want to. So that is an option. Everybody should have some allocation to bank FDs. But if you are in the higher tax brackets, then definitely debt mutual funds are better tax efficient products.
Right. So, what do you think are the mistakes retail investors make in choosing a proper asset allocation, or what have you come across in your years of experience as to where do they go wrong in asset allocation?
So one is jealousy that creeps into the minds of investors, seeing the other investors getting more returns than what they have earned. So they would probably have more equity than they should have in their portfolio. That's one big mistake that people make. Second is over diversification. Having too many mutual funds, PMS within the investor's portfolio is also, harmful. I would say harmful to your investor wealth. So, given that most of the mutual funds have 50 stocks in the portfolio, if you have more than five mutual funds in the portfolio, then you're probably holding the Nifty 500. Then it's very difficult to beat the Nifty 500 returns. So that's other mistake. So another thing which I would like to point out and which our fund has been pointing out since our inception is that geographical diversification is very important. So going beyond the boundaries of our country is very important. You get immune to local geographical factors. Like if you see at the time of demonetization, US did well. At the time of GST implementation, US did much better than India. So obviously, I'm just talking about US, but there are other markets as well which have been doing well. So it's better to have some part of the portfolio which is focused towards other geographies. So yeah, briefly, these are the mistakes which usually the retail investors make.
Yeah, so I think that is why a trusted fund house is needed, to help the investor, and definitely mutual fund advisors are needed to help them plan better. So, so there is a lot of, off late, a lot of, considering example of a very famous fund house, which the debt funds of which actually got messed up, and how the defaults happened, and now they are sort of trying to stay afloat. in India. So, how amongst debt funds also, how do you secure, how does an investor get that security, against that risk, against that credit risk? And how is, maybe PPFAS with its new fund ensuring that, or what is your take on that?
So we have our liquid fund since about 3 years now. So if you see our liquid fund portfolio, we have very little corporate exposure. So what we have done there is mostly we invest in sovereign rated securities, and we add a little bit of corporate exposure where we feel that chances of default are very very low. So basically, number one criteria is either it is PSU or AAA rated. Second, it has a very good credit rating. So, and third is the credit quality that we evaluate in house. So, credit rating is one thing. Second is evaluating it on the fund houses side. So, internally also we evaluate whether not if even if it's a PSU, we have seen that there are chances that there may be a delay in payment or so default we haven't seen, but ILNFS was counted as a quasi PSU at that point in time. So so that is something which we have been conscious about, and credit risk is something which we do not want to take in our portfolios. So in liquid fund, we have taken a very, very limited credit risk. Obviously, you cannot eliminate the credit risk, but you try to minimize it as much as possible. On the new fund, I'll speak about it when we talk about it in detail.
So I think let's come to that. Let's come to the new fund offer, which looks quite exciting because PPFAS, after a long time, I think almost a gap of couple of years now, is coming with a new fund. And this fund house is actually known for very, very simple, crisp funds, not like 100 funds on various categories. So why don't you introduce the fund to us?
Yeah, sure. So the thought process behind launching this scheme was that, as you said, we don't have too many funds, and we launch any new fund only when we feel that it's a differentiated product and we feel that we can invest our own money in. So that's the basic criteria that we have for launching a new fund, and that's why you see one fund which is a flexi-cap, which takes care of the equity exposure. One is the tax saver, which takes care of the ELSS and ATC benefits. Third is the very short-term liquidity needs, which is the liquid fund. And now we have a fourth fund, which is called the Parag Parikh Conservative Hybrid Fund. So, though it is in the conservative hybrid category, we would want to call it a debt fund. So, basically, the thought process was that since most of the investors have exposure towards bank FDs and small saving schemes, we wanted a product where investors don't have a lock-in period, and at the same time they have a tax efficient return. So we wanted a product where we could go anywhere on the debt side. So be it AAA rated, sovereign rated, or be it short dated, long dated, everything that we could do. Just like the flexi cap scheme, which could do everything on the equity side, we wanted something on the debt side. So that's the basic thought process behind this. Brief allocation of this fund would be minimum 75% in debt securities, which would go up to 90%, whereas the balance would be a mix of equities, REITs, and inmates. So this is the brief allocation that we have. And what this portfolio will do is that it will not only be able to beat inflation, but also grow along with inflation. So that's the basic thesis behind this one.
So, how would you differentiate this sort of a fund from the other dynamic, balance advantage funds that are there in the industry? Because those have definitely been doing very well. Is it on the same lines? Is there going to be a lot of churning within the debt, or is it going to be a very stable, secure sort of a fund?
So balance advantage funds are a little different in the sense that the equity and the debt allocations that they have can vary depending on the market situation. Whereas this fund has a allocation which is in place and which will be taken care of over the years. So 75% minimum will be in debt where no matter where the market is. Whereas the balance 25% can be in equities, REITs, inverts, anywhere it can be. And if we feel that equity markets are overvalued, then we can be 90% in debt also, whereas balance 10% can be in REITs and InvITs. So this is the it's a narrow range of investment opportunities that we have compared to what Balanced Advantage Fund has. But at the same time, what this does is it takes care of the debt allocation of the investor. So this is meant for say a young investor who wants a debt allocation and doesn't want to put his mind as to which category should he invest in out of 16 categories that the mutual funds have. Or if a retiree or a senior citizen wants regular income out of this fund, then probably they can take a dividend payout option. Or if even if they are in the higher tax bracket, what they can do is after 3 years they can do a systematic withdrawal plan. So that's the options and the kind of investors that we are looking at for this fund.
So what is the time horizon you're suggesting an ideal young investor should have in this kind of a fund?
So 3 years minimum is what we are suggesting, given that what the tax efficiency that the investment beyond 3 years bring in. So you get indexation benefit. You don't get tax for the inflation part of the returns. And on the other side, since the maturity of the portfolio or the duration of the portfolio will be on the higher side, given that we will not take credit risk, and to beat inflation, either or you need to take credit risk or interest rate risk. So credit risk is something which we will not be taking, whereas interest rate risk will be there in the portfolio, and so the maturity or the duration will be on the higher side. So 3 years plus is definitely something which the investor should be looking at.
Okay, so I think we have a question which is related to this conversation that we are having about interest rates. So Ganesh has asked us, would you be rebalancing according to the interest rate cycles?
So little bit balancing will be there, but at the same time, timing the interest rate cycle is not something which we will be doing. So interest rate cycle timing is something like आपको market क्या लगता है, market क्या करेगा next 12 months में. So you don't have a definite answer to it. At the same time, for interest rates also, you should not have a definite answer to it. So some trends can definitely be seen, but accurate predictions about the interest rate cycle is something which no one can make, and that's what we'll not be making. So, there will be some allocation changes that we'll be doing, but it will not be that dynamically managed.
Okay, okay. So coming to the equity part of this, so I think about 25%, but you're saying that it is not that it essentially has to be 25% at all times. You can increase the debt part as per the markets. But where is this equity? What kind of stocks have you looked at that this equity part should be invested?
So the universe that this fund will have is a little on the conservative side, given that it's meant for the debt portfolio or a hybrid portfolio where the investor needs are a little different. So it will be more oriented towards stocks which have very strong cash flows, which give high dividends or do buybacks. Second is stocks which have a high margin of safety. So in terms of valuation, we feel that they are cheaply valued. And third is obviously we can do some special situations like open offers, buybacks, etc., which can give fixed returns. So these are the broad type of stocks that we will be investing in.
So I think I'm getting another question here that within the category of debt funds, which is this fund similar to? So if you, or is it an absolutely unique fund?
It's not, I would not say it's absolutely unique. So if you look at the conservative hybrid category itself, most of the funds have the same mandate, given that 75% has to be minimum in debt, whereas balanced 25%, what other schemes have done is they have invested in equities, whereas REITs and InvITs is something which is a differentiated product compared to other schemes. So other schemes don't have REITs and InvITs in their portfolio. This is something which is different. And on the other side, what I would like to point out is the expense ratio. So if you look at the expense ratio for most of the schemes in the category, it's on the higher side. So anywhere between 0.7 to 1.2%. Whereas if you look at the expense ratio for this scheme, so for the direct plan, we have kept it at 30 bips, whereas for the regular plan, we have kept it at 60 bips. So it's very competitive in that sense. And what this does is basically if for example, you are earning 6% returns and 1% goes in the expense ratio, then what the investor is earning is lower than the fixed deposits also. So,
Yes.
what this does is kind of tries to beat bank FD returns and gives a tax efficient kind of returns.
Yes, and you also mentioned REITs and InvITs. So I think when the flexi cap, which was earlier known as the long-term, LTEF,
Yeah.
so that also had some REITs and InvITs exposure. But this is a very newish category in India, and not many funds actually have instruments. So have you looked into instruments which you will be purchasing under this REIT and InvIT category?
So, for the FlexiCap scheme, which was erstwhile a long-term equity fund, so we had an enabling provision to invest in REITs and InvITs after SEBI allowed mutual funds to do so. We had an enabling provision, but actually we had not invested in the FlexiCap scheme, given that the opportunities that we have in that scheme are a little different because we can go global as well. So but for this scheme, we feel that we will be investing in REITs and InvITs, given that you get a stable rental yield plus the capital appreciation option. So there are about 3 to 4 REITs which are listed, whereas InvITs also recently Power Grid came up with a InvIT IPO, whereas there are some others listed also. So there are options which are available, and we'll evaluate it as and when the NFO closes.
Okay, so but do you think that this REIT and InvIT market, in fact, we have a question regarding that also, that do you think this market evolving and maturing on its own, being a separate category altogether? You
So
know,
definitely, it's a very, very good option. So if you specifically say, look at, for example, I'm just taking REITs as a example. If commercial real estate is something which is growing really well in India, so if you look at the some of the top 6 or 7 cities, commercial real estate is doing really, really well in terms of the rental yield. So if you could and get somewhere between 6 and 8% kind of a rental yield, plus the capital appreciation that it can definitely give returns which are better than what a government bond would give typically. So definitely it's a big better option. But at the same time, what you need to evaluate is the geographical diversification that the REIT has or a client concentration. So I mean, mostly all MNCs or IT companies or top companies would be the clients of the REIT. So in terms of collection efficiency, they don't have an issue. But if you compare it with, say, a road InvIT, then collection of toll is something which has been a problem traditionally. With probably FASTags coming in, it will be much better going ahead. So that's the basic difference between REITs and InvITs.
right. And coming back to this fund, so this is going to be a completely domestic fund, or does it have any sort of an international exposure, like
No,
FlexiCap does, or yeah? So.
this will be a domestic only fund. International is only in the FlexiCap scheme, whereas the rest all the schemes are domestic oriented.
Right. And as you know, you're right there in the debt market and you understand them very well. So what is your outlook on the interest rate cycles going ahead?
So as I said, interest rate cycle predicting interest rate cycle is something which we do not want to do. At the same time, what trend that I could give is that going ahead in the near future, we could see interest rates stabilizing at these levels. Interest rates falling from here is a little difficult or a low probability event, whereas interest rate rising over a longer period of time is something which we could see going ahead. Whereas I think in the near term, the rates could be more or less stable over here.
Right. So, considering the situation right now, we are in the middle of the most, severe pandemic that we have probably our generation will see or has seen. So, what is the kind of impact do you think that will have on maybe funds altogether, investments altogether, or this fund? What is this pandemic's perspective? If we think towards this fund.
So last year was much worse compared to this year, given that we know what's the end solution to this. It's vaccination for everyone. Definitely, what we have seen in the recent times about the lack of oxygen, lack of beds is something which is a worrying factor. But at the same time, if you see the businesses, manufacturing facilities are working normally, whereas the exports are not working normally. So on the business side of things, it's not that interrupted compared to last year. So last year, the supply chains were completely disrupted, and at the same time, all the shops, etc., were closed. Whereas this year, we have seen the grocery shops remaining open, the chemists remaining open. So most of the basic necessities are being delivered to the customer. So I see that 3, 4, 5 months down the line, when the vaccination reaches its peak, we should be fine, and we know the end solution. So market is factoring in 3, 4 month kind of a thing, whereas after that we'll see a recovery.
Okay, so I think there are a few more questions that we have come in for you. So we have that. You're a mutual fund person, so there are a lot of advices that people want on this live chat. But so basically, again, something that you've already answered, I think. But how many mutual funds should be there in an ideal portfolio, and how many funds should an investor own, and from what all categories? So overall, you can give a little picture overall as to what is the kind of a distribution between equity and debt funds, mutual funds. How
So
to select
as I
how
said,
to select a mutual fund.
So as I said, it differs from person to person. If a investor is 30 years of age and he has 30 years to retirement, then probably he'll be doing better by having a higher allocation towards equities. Whereas if someone is 55 years old and he has only 5 years to retirement, then he would have a higher allocation towards debt. So also the risk appetite is something which will be different between two 30-year-olds. So again, it differs from person to person. Briefly, if someone is 30-year-old and can take risks, the equity allocation should be somewhere between 70-80%, whereas the balance can be in debt. Whereas as you grow older, the equity allocation should come down and the debt allocation should go up.
Right. So we know that this fund offer is coming, but is PPFAS also looking at some more diversification, more funds, gold funds, technology funds, completely international funds, because a lot of those are coming up. So what is the fund house's perspective towards all of them?
So nothing in the near future. We don't have anything in the works. As I said in my earlier answer, we would want to launch a fund only when we find something interesting to put our own money in. So definitely it will not be a sectoral fund or a gold fund or something like that, because there are enough funds which are there in the market which are sector specific and they invest in that. We don't have any, sector specific is something which will I probably not do. Uh, International funds, so there is a restriction of SEBI in terms of how much per fund house can invest internationally. It's $600 million per fund house. So we want to keep that limit for our flexi-cap scheme. We do not want to, utilize it by cannibalizing through other schemes. So international fund is something which is not in the works in the near future unless we see some regulation change.
Right, right. So, Mr. Mehta, I think we've covered a lot of ground. You've been kind enough to answer a lot of our questions and a lot of questions of the people who are a part of this chat. So, why don't you give some closing remarks and tell us when this NFO is launching?
Sure. So NFO opens on 7th of May and it will be open till 21st of May. You can invest through any of the online options. Physical, I would want to avoid given the situation that the country is in. So you can avail of any of the online options or either of the apps like ET Money, Paytm Money, or Grow, Kuvera, etc. So you can invest through that as well. And yeah, that's it. The scheme reopens on 28th of May, and you will see the first portfolio, and you will have a broad sense of where we'll be investing in.
Right. So thank you, Mr. Mehta, and thank you so much for sharing everything with everybody who was a part of this, and all the best for your new fund. We're really hoping it does well. So thank you so much.
Thank you. Thank you.
Thank you.